Well, g'day there, traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me on this weekend market update. What I'll be doing over the next 10 to 15 minutes is really giving you, or at least speaking about some tradable opportunity which we see on the horizon over the upcoming 4 trading sessions. This is really going to apply to that of silver and gold. We will also have a quick look at the US dollar index because again, it is bouncing off that macro support, which is what we've been expecting for quite some time. And again, given of course the inverse relationship between the purchasing power of the US dollar, what does that mean for of course gold and silver, these types of commodities which are priced in the US currency? So what I'll be doing really to begin this discussion is really beginning with the US dollar. Now obviously we've been speaking about this for quite some time. We've really been discussing again this macro support and where X marks the spot, that being on this particular trend line. As you can see on my screen, what I'll do for you, let me just bring up my drawing tool because at the moment it isn't really operational. I need to make sure that it is synced up, which is going to be a little bit of a delay. There we go. Omni Dazzle, please close me. Perfect. As you can see, this is completely unscripted. It's me sitting down and bringing you this analysis. But if you go back and have a look at some of our historical videos on the YouTube channel, we've been discussing this green box, this macro support box. And also if I begin changing to the weekly chart, you can see this extended long-term sustainable bullish trend line, which has really been underpinning the performance of the US dollar since around mid-2016. Now this extension out into the future has been met, and most recently it was tagged or touched towards mid to late March 2017. Since this reversal candlestick just here, or even this particular candlestick, we were speaking about the expectation and the likelihood of the US dollar reversing on a dime, so to speak, and continuing its macro upward trend. Or if you pay attention obviously to price action over the past 2.5 weeks, you can see it's up. We did see a little short-term consolidation here over the past 1 week, but again, even at the close on Friday, we are continuing to see some very strong purchasing power flow back into the US dollar. You can see the stochastics, the RSI and the MACD supports this turn up. One piece of advice for you at this particular point is that there is the potential that we are in some form of a decelerating or descending triangle, and oftentimes what will happen is that we'll oscillate back up into roughly this area or this downward sort of trend line. As you can see, this is what we call a short-term trend line. So it isn't as important as this macro trend, which I just pointed out to you on the weekly chart. Really what I'm hinting at the moment is that although we have seen a lot of strength flow into the US dollar, which doesn't come as a surprise, there may be the opportunity that we get one more sort of sell-off in the US dollar and sort of move more towards the apex of the triangle itself before we see that long-term macro sort of upward breakout, which is what we've been expecting. So I guess at its core, if we're expecting the US dollar to continue to appreciate in value, what does that mean for gold and silver? Well, as you can see, especially given Friday's trading session, we have been more or less stalking silver and gold for a really good tradable opportunity and entry spot. As at the close on Friday, we have been triggered into silver. All right, and the reason why I say we've been stalking this trade, so to speak, is because of the big macro picture. If you pay attention to commodities, really since 2011, they have been in some form of a macro correction. There's no doubting that. It's really all not that much, all that contentious, I should say. And what we discover, all right, from time to time is that we get these intermediate market bounces. It doesn't matter whether you apply it to the market indices or whether you apply it to individual companies traded or listed on the equity markets in America or around the world. It is just, again, patterns repeating, and I guess trader psychology, which we can pick up on in the world of technical analysis. What we have essentially done at this particular point, and again, go back to a video I posted, I think 1, if not 2 weeks ago. It was labeled Pivot Point Silver and Gold. We were talking and discussing the importance of this macro or intermediate sort of resistance point that we're coming back, or that we were at that particular point coming back up to. We were speaking about these candlesticks in conjunction with the downward trend, which is still in effect, and the very important distinguishing factor being that we are still failing to price in macro higher highs. So as you can see, silver's come back up. It's failed just shy of 1750. Why is 1750 so important? We were at 1750 towards the end of February and also early March 2017. We were looking into, of course, some of these gaps, very similar to what we've seen on the Dow, the S&P, and the NASDAQ. And we were potentially, or at least we were asking ourselves the question, is this some form of an exhaustion type of candle? And it was my expectation, or at least my outlook, that this was going to fail. And as you can see on Friday, if we fast forward from this gap towards mid-March, you can see we've got a plethora of spinning tops, We've got a high wave spinning top. We've got multiple shooting star candlesticks, as you can see, which I'm sort of circling for you, or at least highlighting to you. We've got a perfect doji candlestick over here. Wednesday and Thursday, we tried to at least develop traction, or at least a little bit of grit for potentially an upward move. But then here we go, the vote, so to speak, in terms of price action between demand and, of course, supply, or at least buyers and sellers. We can see who obviously won this battle at this particular pivot point. You can see this big long day Moroboso. It is what we call an engulfing candlestick. And also pay attention to volume. You see this volume which is being elevated, or at least it is elevated on Friday's trading session. This is a major warning signal for people who are holding gold or silver ETFs on a short-term time frame. This may also play out with a bigger correction which is going to unfold further into 2017, as long as the US dollar, macro remains healthy and it does hold above that structural support level. You have to keep a long-term, or at least an intermediate view on commodities that they are going to be under pressure moving forward. And again, this may be the beginning of what we call a sentence in the world of technical analysis. We've got all of the signals, all of the indicators again, which are supporting sell signals. Look at the daily time frame just here. All of these, pardon me, just crossing bearish. You can see the MACD about to turn down. We've got some very mild divergence, even though we didn't really price in a higher high. If you go out into larger fractals, this is where it becomes even more concerning. We've got peaks in the past in mid-2016 before we entered into corrections. This is on the weekly chart right now. And pay attention to these signals. The histogram is only just trying to print into positive territory, or at least the slow line is trying to get above this neutral line here. But again, if you pay attention to the Stokes and the RSI, they are both sloping down, and the RSI itself has got two, sort of almost like a double top pattern, which is being or becoming pronounced at this particular juncture. So pay attention to this. It is very important. The reason for this video is because we have some tremendous opportunity on the downside. Personally, I'm in silver contracts, right? Options contracts. I bought different puts at different strikes, and this is more so an intermediate trade for me. My target on silver, at a minimum, is down here at about 14.90. Here we are at 17, and we were, executed around 17. This is going to be a huge trade in terms of percentage, if in fact it continues. Now you have to allow a little bit of room. You have to allow a little bit of, or allow a little bit for market noise. And of course, oftentimes when we come back down and fill the gap, we will get a short-term relief rally. Now, if we do get that rally, I expect it to fail. I expect it to fail below the highs, which we've just established towards the end of March, also early April. So again, this is what we call an inflection point in the world of technical analysis. The sentence is, forming its beginning, and I'm bringing this to your attention. This isn't actionable, tradable advice. This is just me sharing my thoughts, obviously, on what the market is doing, and sharing with you some analysis which I perform, and which I'm applying to the US financial markets, which are very much so applicable to the current juncture. Silver just executed as at the close on Friday. If I move into gold, you can see also we do not have an engulfing candlestick. Nor do we really have an sort of like a long day Moroboso candle. This is what we call a bearish counter attack, although it isn't a textbook formation. You can see how we gapped up again. But during the trading session, we traded down and we closed more or less very close to the previous day's candle. This was after what we call an inside day harami. So we've got all of the reversal candlesticks. It is showing up at the right location. We did overshoot this short-term resistance swing high. So what this means, what this triggers, is that we do have confirmed divergence on gold, which we don't have on silver, which again just continues to stack up in the bearish direction on the medium term. This is a rather aggressive entry, 117.76. If you want to be a little bit more careful or delicate in your approach, you'd be looking at about 113.82. That will be a break of this little intermediate swing low. But again, it would just be a further confirmation that the trend itself is reversing. If you change to the weekly chart, pay attention to the Stokes, pay attention to the RSI. The MACD is still trying to push up into positive territory. Although it's there in the histogram bar, I'm not sort of discounting that whatsoever. When you see the print, or if you see the MACD again try and push up and firm up very close to the neutral line but fail and turn down, it generally is again the confirmation that the trend, of course, being a longer term sort of correction for commodities markets, again since the peak in 2011, is going to be further withdrawn or prolonged. So I just want to warn you about that. And again, it really stems from our discussion and our analysis, our macro sort of view on the US dollar. What is our macro view, so to speak, on the US dollar? If we go to the monthly chart and zoom out, there is a very high probability and expectation that we are going to see the US dollar strengthen to at least, at a bare minimum, 112. Here we are, more or less at 101, and we can even call it 100 on the nose. So we have at least about 11, if not 12% at a minimum for, again, the US dollar to appreciate. We can roughly expect, if that's going to be the case, we can say that, from these current prices for commodities, we would expect some further devaluation moving forward. So again, it's a very important relationship. It's what we call an inverse relationship between the purchasing power of the US dollar and the currencies, which of course, they are priced in being the US dollar. So think about that. Although you may not be in US dollar exposure, or you may not have open exposure to, for instance, the ETF UUP, there is going to be some very nice tradable opportunity to take advantage of this current rally taking place, or at least the resumption of this long-term uptrend. Again, go back and watch that video. We warned about it, we spoke about it, and it was, blatantly obvious at this particular time. So think about this, but also be open to, again, the apex, or at least the movement into the apex, which is going to coincide with most likely a short-term relief rally in gold and silver. So please listen to what I'm saying. I'm not saying that the price of gold and silver is going to collapse. There's most likely going to be a little bit of consolidation and a little bit of market volatility, so to speak, where we're going to see some nice sell-offs followed by some pretty aggressive buy the dip type of trading mentality. But once this all shakes itself through the system, you should see again this sort of natural dynamic of equilibrium between the two markets sort of just settle out, and then we'll start trending in these opposite directions moving forward. So I wanted to bring that to your attention over the weekend. It's very important, and you should be well aware of it. If you want to learn more about this and some more analysis, I would encourage you to have a look at that pro analysis class. We break down the 3 US markets, also the transportational average and the Russell 2000, followed by our top 12 individual trade list, as you can see on the left-hand side of my screen. All the best, everyone, right around the world. It's James signing off on behalf of Pivot Point Trading. All the best. Goodbye.